Hedging your stock positions. Hey everyone, it's Wolfgang. What is hedging? Hedging is a way to protect your investments. It's an attempt to protect gains generally. It's a way that you can protect yourself financially. It's not an exact science. There's uncertainty about how successful you'll be and to what degree you'll be able to protect your gains. And because of that uncertainty, you have to tolerate a little bit of slop. But if you're invested in an ETF or a mutual fund, or if you buy individual stocks, which, I don't do that, but some people do, then you're already in this frame of mind of, I know this can go up and down. I'm okay with that. So that's what I mean by uncertainty, tolerating a little bit of slop. We don't really know where the market is going to go. So an example of hedging: selling covered calls for income. A covered call is you selling options on positions that you own. You make income right away. You hold on to those positions. So I'm going to give you an example of this further on. I will explain selling covered calls in just a couple of minutes here. Okay. Let's take a look at the stock market for the year. It is up for the year despite the iffy job market. Some parts of the U.S. economy have done well, right? Some profit taking is occurring today. A little bit of profit taking in the market. So what should we be thinking about as we approach the end of the year? So do you have gains to hedge? If you have gains for the year, and most likely you do, hedging those gains to protect them, it's not a bad idea. It's like anything else. You buy insurance if you drive a car or if you own a home. You might have business insurance. You never know when you're going to need it. You probably won't need it, but it's not a bad idea to at least consider it. So towards the end of the year, do we have gains we'd like to protect? The answer could well be yes, because the stock market has done well this year. You can rank your holdings for their upside potential. Example, the Magnificent Seven, the stocks like NVIDIA that have done, very well in the Magnificent Seven, how much upside do they have compared to something that is in technology but has not been in the AI space, that's doing okay, but maybe not like the Magnificent Seven. So you can rank your holdings in terms of their upside. If you say to yourself, okay, this has gone up substantially, this ETF or this stock has gone up substantially this year compared to other things, so this might be a candidate for hedging. Example, the Magnificent Seven stocks, they've had quite a run. Okay, so how do you approach this? It's not black and white, all or nothing thinking. It's let's take a look at what we own and maybe sell a portion or protect a portion. You can incrementally sell your winners, a portion of them. You can say to yourself, okay, we bought NVIDIA at, $100 a share. It's now close to 200. That's 100% gain for the year in one stock. That's a winner. You might say to yourself, I'm going to take a portion of that off the table. Maybe hold on to a portion of it, but take a portion off the table. You can take the cash proceeds for the sale and put into U.S. Treasury bonds and wait for an entry point. What is an entry point? When the stock market corrects, most of the time, all the stocks in the stock market drop, right? Not just a few. Generally, when there's a market sell-off, the whole market will tend to drop, the level. That can be an entry point. That can be, you can say to yourself, okay, everything's dropped, might be a good time to buy. So you can sell a portion now if you've had a big gain, put it into treasuries to earn a decent return while you're waiting for an entry point, a correction maybe. So this year so far, what has the market done so far this year? Okay. Now there is some selling, there's some profit taking today in the market, November 4th. Okay. So this may not be totally accurate, but as I was preparing the notes for this video, the Dow Jones Industrial Average was up about 11% for the year. The Russell 2000 small caps stocks was also up about 11% for the year. The S&P 500 was up about 16% for the year. Pretty darn good, right? The NASDAQ composite, wow, 23% on the year. Now, who knows where the market will end today, right? But these numbers were valid when I was making the notes for this video. The SPY Exchange Traded Fund, that's an ETF for the S&P 500. It's up 16% like the S&P 500. The QQQ Exchange Traded Fund, this is the top 100 NASDAQ stocks. A lot of them are tech stocks, is up 23% for the year. So you could say to yourself, if you're going to rank which of these holdings that I have in terms of their upside potential, how much higher can they go? You might say to yourself, 23% for a year is a good return. 11% is also good, but it's nothing quite like 23%, right? So you might say, let's take a portion of this off the table, just as an example. I should point out, I'm not a financial advisor. You should consult your financial advisor before making any investment decisions. But I'm just saying, to apply this, you can rank your holdings in terms of their upside. You might say 23% for the year return. How much upside does this have compared to the Russell 2000, which has done quite a bit less, 11%. This may have more upside than the QQQ does. Who knows? That's a decision you'd have to make with help from your financial advisor. Okay, so here's an example of covered calls. Okay, here's what a covered call is. Let's say you bought 1,000 shares of NVIDIA in April of this year when it was selling for just under $100. Let's say $100 round numbers. You bought 1,000 shares of NVIDIA for $100 in April of this year. You still own it. NVIDIA is trading over 195. Last time I checked, it was close to 200. So let's say you bought NVIDIA at $100. You could, to hedge that winner, because that's a huge winner. You bought it just a few months ago for 100. It's now close to 200. You might say to yourself, I'm going to protect that gain. I'm going to hedge my position by selling covered calls that expire December 19th of this year. So that's a good 6-7 weeks away from now. So right now, when I check this, the covered calls that expire on December 19th are selling for $15.60. If you have 1,000 shares, you can immediately raise $15,600 in income. Okay, so a covered call option, whoever buys so if you contact your broker and say, I want to sell 1,000 covered calls with a strike price of $195. Did I write that down here? I forgot to write that down. Okay, so for this example, the strike price is $195. So the person buying those from you will exercise the option and will take your 1,000 shares if NVIDIA is over $195 a share on December 19th or before. If NVIDIA runs up to 220 next week, then those options may be exercised and they may take the stock from you. So you sold your NVIDIA at 195. I forgot to write that down, I'm sorry. So 195 is what you sell your NVIDIA for. You bought it for 100. So you made $95 a share profit times 1,000 shares. You made $95,000 profit and the $15,600 when you sold the covered calls. So you've locked in your gains and you've made some cash income. Because when you sell the covered calls, you still own the stock because it may not be exercised. If NVIDIA falls to 150, the calls will not be exercised, all right? And you'll keep owning the stock, but you will have protected yourself with $15,600 of income. So this is what I meant by tolerating a little bit of slop. So let's just run by that again. Let's look at the possibilities. Let's say NVIDIA right now, this is all hypothetical, is $195 a share. You sell 1,000 covered calls that expire on December 19th, $15.60 each. You sell for 1,000 shares, you raise $15,600. That goes into your account. Someone holds those covered calls. So there's three possibilities for the price of NVIDIA between now and December 19th. It could stay the same, whatever the price is today. If it's 195, we don't know if the options will be exercised or not. They may not. That's possibility one. Possibility two, let's say NVIDIA falls from 195 to 140 a share, and you still own the stock. So have you taken a loss? Not really. You paid $100 for the stock. It fell to 140. You made $40 a share plus $15,600. Possibility three, NVIDIA price jumps from 195 to 220. In that case, your gain is locked at 195. Even though NVIDIA jumped to 220, if you sold covered calls, you were selling an agreement to sell your NVIDIA at 195 by December 19th. So the options will be exercised. The stock will be taken out of your account and you will receive $195 a share times 1,000 shares. Okay? So you get the idea. But the cool part about this is you've got $15,600 to protect you if things don't go your way. If you notice that NVIDIA is dropping, the call option will not be exercised. And instead of suffering just a loss, a relative loss from 195 to 140, instead of that, you've taken in $15,600 in income. A covered call gives you income now for stocks that you hold. the option is covered, meaning you still own the stock. Okay, I'm not going to get into naked options. Those are extremely risky. You can look that up if you want to, but this is a pretty safe way to hedge a position, to say to yourself, I bought it 100, it's 195 now, I want something, I want to protect that gain a little bit. At the end of the year, if it dropped to 140, you made 15,600 as a consolation prize for holding it. It probably was going to keep going up because artificial intelligence, NVIDIA has huge demand for its products. So you're probably going to do okay over the long term. So hedging your stock positions, this is just one example using covered calls. There are other ways to protect your position. One of the most important things you can do is you should avoid a black and white, all or nothing mode of thinking where you say to yourself, okay, I've got a huge gain, I'm going to dump everything and just get out of my position. You might instead say, I'm going to incrementally sell my winners a portion, not all of it. Another option is to stay fully invested and say, I know the market's going to go up and down. If I see an entry point, if the market drops, I'm going to buy more. Some people do that. So, and they just say they're content with the fact that the market is fluctuating, is always going up and down. So if you have any questions about this, we've all done pretty well. I mean, if you look at this, the Dow Jones Industrial Average being up 11%, that alone, over 10%, that's a very nice return, right? Because what can you get at a bank? If you were holding the SPY ETF, the Standard & Poor's 500 ETF, you're up 16% on the year. And that's a huge basket of, that's diversified. That's really nice compared to what you can get from bank, a CD or U.S. Treasuries. That's a very nice return. So we've all done pretty well for the year. So something to think about hedging. If you have any questions, please post in the comments. I'll try to answer your questions. I really want to thank everyone for watching. Have a great day.